Good morning, everyone. My name is Greg Leonberger. I'm the Director of Research. And if you're paying attention, you actually saw my face about 10 slides ago. Yep, that was me on the airplane. So anyways, I'm here to talk to you about real estate. And I have some good news for you. I go to a lot of these conferences. I speak at a lot of them. I attend a lot of them. When I attend them, I try to sneak my phone every now and again and check my email. And when I'm out speaking, I can see who's on their phone or not. And the good news is, we're going to make this interactive. So you have the perfect excuse to pick up your phone right now. I highly encourage you to do so. Scan this QR code because there are going to be a couple questions over the course of this presentation. I'm going to ask you for your responses, and that will at least partially inform what I say. So I'll give about 10 seconds here. I think we all have been through this before, so it shouldn't take too long. Nothing will show up for you right now. It's when I get to the actual pages where the questions will appear. All right, I see most phones down. So, agenda. I'm going to start by asking who's frustrated, okay? And there's going to be a little more color to that question generally than just who's frustrated because, let's be really honest, we could spend the whole day just talking about who's frustrated about whatever. I'm going to try to convince you that the real estate market has bottomed and we are on our way back up. Then we're going to talk about how the real estate market is branching out, branching into different sectors beyond the typical four main food groups of multifamily, retail, industrial, and office. Last, we're going to finish with the real estate reminder. So, the first question, as promised, who's frustrated? And specifically, are you frustrated with your real estate allocation? And we're going to leave this open. You can define it however you want. Returns, liquidity, managers, there are varying degrees of very frustrated to not at all frustrated. I have an idea of how this is going to shake out, but I'm going to give everyone another 10 seconds or so. And if you missed the first opportunity to scan, we actually have it up here again. So again, we'll let this play out for just a few more seconds, and then we'll move forward. So these numbers appear to be relatively stable. And honestly, I'm a little bit surprised. As a director of research, when markets are good and things are going well, my phone's pretty quiet, not too many people stop by my office. When things are going sideways and when the market's in free fall, I get a lot of consultants calling me and say, what can we say about this? What can we do about this? And I've had more requests than not for real estate over the last 2 years. So what we wanted to talk about first is, has the market bottomed? Do we think the real estate market has seen the worst of its returns? Are we on our way back up? And I'm going to argue the answer is yes. We can try to answer this question by looking at a number of different data variables or data feeds in and out of the real estate market. And we're going to start with debt markets, okay? I personally can't go buy a property. It's hard for a lot of portfolio companies to buy properties without borrowing money. The public versus private panel earlier talked about how in 2022 the market's kind of seized up. You see that manifest itself here. This is originations in the real estate market in terms of debt. Okay, you saw it really bottom in early 2023, on the rebound since. Okay, and not surprisingly, as we look at transactions, you see a similar trend, right? A bottoming in early 2023. And since we've been on an upward march, not a radically higher upward march, but we've gone from about 100 billion to 150 billion over 2 years, 50% over 2 years. I think that's pretty good. It speaks to the direction of where transactions are going. And not surprisingly, you're not going to see transactions if prices aren't satisfactory to both buyer and seller. In March 2022, real estate prices hit their peak, then fell 22%. Focus on the very right-hand side of this chart. You're starting to see a gradual recovery. Again, gradual, okay? We're not rebounding here. It's not a massive spike, but you're starting to see prices move in the right direction. But as investors, as holders of real estate assets in your portfolios, maybe this is interesting, maybe it's not. What really matters is returns, right? Well, your returns have been positive now for 3 consecutive quarters, okay? These aren't 9%, 8%, the returns we got used to seeing over the better part of a decade in the previous real estate cycle, but they're moving in the right direction. I'm going to offer this as the final effort to convince you the real estate market is on its way back up. If we look at forecasted income growth, not income growth, and calculate a 4-year projection, those are the light gray bars, compared to a longer-term average with the black bars. For almost every sector on here, your shorter-term income growth is higher, in some cases materially higher than the longer-term average. That speaks to what the market could bring us in the coming years. So question number 2, if I did a good enough job over the prior 4 slides, I may have convinced you that you might want to actually increase the real estate allocation. So I'm going to ask you that very question. I'm somewhat cynical on how the answer is actually going to shake out, or else I wouldn't have a second half of this talk. But anyways, I'll give everyone a couple more seconds to respond. Okay, good. So the next 10 minutes will be a good use of my time. We're using the term branching out here. I mentioned already that typically when you think about your real estate portfolio, the four main drivers are multifamily, retail, office, industrial. But as we sit here today and look at all institutional holdings of real estate, 13% doesn't fall into one of those four main food groups, and we're going to broadly describe as alternatives. 13% today, projected to grow more into the future. There's a lot of different flavors of what those alternatives are. We're going to refer to this group as the group of five. Now, if you're reading through this really quickly, you could actually say, well, isn't it six, Greg, single-family rentals and manufactured housing? Fair point, but we're grouping them together. It's easier for me to say group of five, quite honestly. So senior housing, medical office, data centers, self-storage, and then again, that grouping of single-family rentals and manufactured housing. Now, before getting into the specific economic and demographic factors supporting the group of five on an individual basis, let's look at projected occupancy rates, okay? If I own a property, I want more people living in it than not. I want more people renting it than not. The long-term averages from 20 to 24, those are the blue bars on the chart in front of you. Look at the orange lines above it. What we want to see is growth in occupancy rate. Now, what I'm going to do is highlight the group of five. The projections are future occupancy rates higher than the longer-term averages. In particular, senior housing and data centers, those are the biggest jumps, okay? Again, further tailwinds for the group of five. We could talk about tenant demand as a very similar argument, so we're not going to spend very much time on this slide. But I want to go back to this slide of forecasted income growth by sector. We've highlighted the group of five here, and they're actually now, you'll see, six, because we split out the two real estate ones, residential ones between single-family rentals, manufactured housing. But if you look at these, compare them on a relative basis to everything on this chart, and took the average of the group of five versus everything else, it would be considerably higher. Okay? So again, talking broadly about the group of five, we can feel pretty good about the outlooks. Now let's get into some of the specifics around senior housing and the other sectors. Quite simply, senior housing, you have a trend of growing population growth, and as we go through the next couple of slides, there are a couple different ways to cut the cohort of the aging US population. What we've done here is 85 and above the population growth, okay? Very clear direction, left-hand side chart. The right hand, that's your growth of new inventory, right? The new inventory for senior housing. That's going in the opposite direction. This quickly becomes an economics 101, right? Demand greater than supply, what does that do to prices? Prices go up. If you supply into this market, if you are renting into this market, if you are selling into this market, that's really good for your returns. We can look at it a different way, and now we're going to talk about the population 80 and above. The trend is still the same. 4% growth in that population year over year. Construction starts simply have not kept up. And I think for some of these sectors, and this is one of them, an anecdotal story can help really seal the deal. My parents are 78 years old. They live in Sarasota, Florida. Relatively good health. 8 years ago, they built a brand new house on the water with a pool, perfect place to go visit during a Chicago winter. About this time last year, they started to think more about their future lives and what health could look like, with an eye towards there's going to be a day when we need more resources, we need more help, we need more of a senior housing, ability to graduate from a single-family home into more care facilities all on the same campus. They sold their place. Heartbreaking for a guy like me who likes to go down there and swim in the pool and hang out during the winter, but they made a lifestyle decision. And certainly one story doesn't make the case for all this, but I will share with you, they have 3 other neighbors from their neighborhood do the exact same thing. So this is a trend, you're going to see more of it as you move forward. Closely related, of course, well, if people are getting older, they're probably going to need more medical facilities. Here we're looking at the age population 65 and above, and I think it's a really powerful statistic. In 2020, there are 56 million people age 65 and above. 10,000 people a day turn age 65. By 2040, we have 81 million people who are age 65 and above, 45% growth. Well, people get older, they need more medical help, they need more medical care. Not only that, but the delivery model is changing. Back, let's call it before 2000, you'd go into a hospital. If you're having surgery, you'd go into a hospital, even if it was a minor operation, you're probably spending the night, right? They were going to keep you, inpatient service. Since 2000, those types of services have fallen by 20%. It has dramatically skewed the other way. Now, outpatient services have skyrocketed 28%. In some cases, it seems a little bit uncomfortable sometimes how quickly they push you out after a surgery, but that's the changing model. So you have 2 really drivers of medical office here. Number one, just there's more demand simply because there are more people who need medical care. Then number 2, the delivery model's changing. So you either need new facilities or you need to renovate old facilities. Again, if you supply into this market, that's great for your returns. Data centers. This has been hit pretty hard already just by the AI panel today. I'm going to share with you this one statistic. If we look at capital expenditure for 4 of the Mag 7, Alphabet, Amazon, Meta, and Microsoft. In 2020, that was $100 billion, okay? It's not all going to data centers, but we've overlaid onto this chart the vacancy rate for data centers. And data centers take a lot of different forms. For these, the term hyperscalers was used. If you're unfamiliar with the term, think of an airplane-sized hangar filled with computers to support the streaming services you offer, the digital services you offer, whatever else that these companies are going to provide to you on a digital basis. 2025, the capital expenditure spending across these 4 companies, $300 billion. That's a growth of 200% in 5 years, okay? But it's not limited to just the large companies. If we look at the IT infrastructure market size, in 2025, that's $800 billion. 2 years from now, $1.3 trillion. It's pretty clear both from these charts and the fact that we spent an hour talking about AI today that data centers will continue to be very much a part of real estate needs and infrastructure needs. Self-storage. So self-storage is something where there's all types of data to digest and analyze for the demand for self-storage. We went really technical here and looked at growth in Google search activity. Second half of 2024, first half of 2025, the right-hand bars right there, look at that growth. There's clearly a lot of interest in self-storage. And as we think a little bit more from an economic perspective, an investment perspective, self-storage presents itself as an anchor to these alternative sectors. I'm not suggesting you park 40% of your real estate portfolio in self-storage, but if we think of it as an allocation and perhaps a little bit of a diversifier or an all-weather type strategy, it starts to make sense. There's certainly a secular argument for this, a cyclical argument, then a counter-cyclical argument. And one of my colleagues was nice enough to share a story that she has a brother who bought a house in 2020, 2021. Rates were really low, okay? Starter home, single at the time. Fast forward 5 years later, her brother's married with kids, would like to move, except we all know the state of the real estate market, right? Not a lot of supply, prices are way higher, and mortgage payments are a lot more expensive because rates are much higher. So what's an alternative to that? Well, you can, you start a family, right? And more and more stuff, and you're running out of room. Well, what do? You rent a self-storage facility. That's a heck of a lot cheaper than doubling your mortgage payment to move into a bigger house. And then residential, finally. And we've grouped these two together, the single-family rentals and manufactured housing. We're showing vacancy rates here, okay, from progressive time series all the way forward to a projection. What you want to see is these bars drop as you go left to right, and that's what you see. If you think through the casing, and single-family rentals, pretty similar to some of the arguments I just laid out for self-storage, right? Can't buy a house, either can't afford it, there's not enough supply, go rent a single-family house. The other one is manufactured housing, and candidly, I think you're going to see even more growth than is suggested here. I'm not here to argue that building a custom house versus a pre-made house is the same thing, but there's probably some people there on the border between I want to build a brand new house, but boy, it's really expensive, and the uncertainty around tariffs makes the cost even more unpredictable. So it might be way more economical for me to at least pursue the manufactured housing. Again, we're not here to suggest that any of these sectors are going to drive your portfolio exclusively, but we think about how real estate's changing, the changing face of real estate, as the title suggests. These are going to be more meaningful parts of future returns. Now, I want to land here as a real estate reminder, because clearly the last 2 years have been difficult to be in real estate. If you look over the longer term, though, what the return pattern looks like for real estate, what you see is the 18 to 24-month market corrections, and then about a decade's worth of steady returns, mostly driven by income. Now, that looks different over the years, right? If I'd given this talk 15 years ago, no one wanted to touch real estate. No, I'm sorry, retail. Now no one wants to touch office. And we're not here to suggest that any of those 4 main food groups are dead, but we are here to suggest that these alternative sectors, particularly the ones we just discussed now, are going to be more a part of your portfolios and part of return drivers. So the takeaways. I think I hit them mostly on the previous page, but I know you're frustrated, okay? Real estate has been difficult. We think the worst is behind us. There are a lot of compelling economic reasons for that. We think the future looks a little bit different for the reasons and the drivers we've already highlighted. We're positive on the long-term investment horizon, and we do think the market looks different. That's the end of my talk. Thank you very much for being a great audience. We're going to take a break, and then we'll hit U.S. equities with Catherine Hillier. Thanks.